Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then. Joining us on the show today are Lancelot Cunha of ValueX, Kalra of Target Investing, and Vinit Bolinjkar of Ventura Securities. Today on Hot Money, we'll discuss stocks like Reliance Industries. It's scaling new highs, almost at the 9 lakh crore market cap. What's aiding the rally, and will the rally continue further? We put the spotlight on mid-sized private sector banks. We've seen counters like a Federal Bank or a Karnataka Bank or DCB come very close to the 52-week high. Will our guest indicate that they be willing to invest in any of the smaller banks? A lot of these cinema stocks are doing well. You're seeing outperformance because of a spate of blockbuster films that are there. So Inox Leisure and PVR, both of them are doing well. We asked them whether the rally will continue, and since it's the start of a new financial year, we asked them what are they advising their clients in terms of stocks that they need to focus on. But the first stock is obviously the big one, Reliance Industries, almost a 9 lakh crore market cap, and single-handedly has led the Nifty much higher, almost at 1400 level. Vinit, Reliance, first of all, what's causing this rally, and do you believe that Reliance will maintain the pole position and continue with this rally?
So I believe that there are multiple growth drivers in Reliance. One is that telecom is here to stay. There is virtually no competition there. Second fact is that if you notice the retail business which is scaling up, and the Kirana stores are virtually on the down cycle now. So there two things exist for these players to benefit from. One is their private labels, and two is shifting the working capital strain onto the FMCGs which work at negative working capital cycle. So as modern trade expands, and I believe that the ramp up and the growth trajectory is there. So these new levers are going to come out, and with all the other traditional businesses continuing to do well, I think there is substantial value unlocking still remaining on a larger perspective.
But you believe that the rally will continue?
It's a momentum rally, and I think it will continue.
What about the telecom space? At one point of time, right now they are giving it at a lower rate. You think that competition again is looking to strike back, or probably Bharti is doing? Is that there where they will have some bit of hiccups?
So I think Bharti will come out unscathed from this, and I think together with Reliance, they will do well, and I am of the opinion that the ARPUs may have bottomed out or close to bottoming out. So any up move in the ARPUs will mean that the profitability of the business will grow up. So what will happen is that the headline number will not be changed, the pack ratings will not be changed, but the tenure for which they are offered will keep gradually coming down. So if you have a 199 pack, say for example, if it is for 84 days, it could come down to 71 days. So every subsequent cycle, we could see a diminution in the time period of that, suggesting that ARPUs are going up.
Okay, what about you, Lancelot? Is Reliance something that you're recommending to your clients, and you believe that this rally will continue?
I think the rally will continue because its basis is a re-rating based on a transformation of Reliance's business model from being a petrochemical and an oil and gas player to actually being a major player in the new age industries of the internet-based businesses, etc., even the retail business. So the promise of that transformation and the expectation that being Reliance, they will be able to achieve what they set out to do, is what is driving the price and the valuations up. And it needs to be seen as to how successful Reliance is in transforming itself from petrochemical into a retail or a internet-based player. So I think that's where the uncertainty comes, and where the stock is running up ahead on anticipation of expectations. So from that perspective, I would actually wait for a while rather than buying at this time, and wait if there are corrections. Also, we need to see how the journey is unfolding in terms of its financing, how it's making the marketplace, what kind of technology is being used for the end consumers. So while the plans have been drawn up, we need to see the implementation and then really take a call as to whether this is possible or not.
So at this point of time, you are a hold on Reliance. You won't accumulate, you would wait for a correction.
I would wait.
But on the long term, are you still bullish on Reliance? You think that whatever they've created, because there are three large verticals, the oil and gas, retail, as well as the telecom, would they be able to deliver on all those fronts?
I think as far as the oil and gas is concerned, there's absolutely no problem. They have been delivering in the past, and future, most of the capex is done. So you should see improvement as far as oil and gas is concerned and petrochemical business is concerned. I think the challenge lies on the telecom space, is where on the retail again they are a major player and they have been able to achieve scale. So with the online retail initiatives, that should help them, compete with the likes of Amazon, etc. But I think the challenge is on the telecom space, because on the telecom space there are huge investments needed. Then there is the move to 5G. And all this has to finally, at the pricing at which you're providing your customers the telecom, the pipeline, unless you generate money from the content, it's going to be virtually impossible to generate profits or a return on this huge investment. Plus the investments have only begun. It's still not yet, completed. So fiber has to go out to last mile, connectivity for all households. And then you are able to bring a content-based approach and say, okay, I'll charge you for the content, but you do not have to pay anything for the bandwidth. And that model is going to take a while to play out. It's also difficult to see how you can manage to finance this whole thing without putting a strain on the resources of the company. So that's where the doubt lies, really.
Okay, and what about you, Samir? What's the sense that are you recommending your clients to accumulate Reliance, or what's the sense that you're having?
So we are a buyer on dips. We are not buying as the rally continues. The only reason is, if you see the deleveraging part, this year I believe FY20 will be deleveraging story for Reliance. If you see, it's been only 2 days and they've already transferred the tower assets and fiber assets to the trusts. So now on the consolidated basis, the deleveraging starts. And that's the biggest plus point from my point of view in FY20, because that helps the cash flow generation to be utilized in much more asset-light businesses or in a much better way. So I think, and secondly, the Reliance retail addition of store is still going on at a faster pace. So I think even that kind of a monetization, whether it's IPO or any other way, will happen out by this financial year, some way or the other. And the third, which was their pipeline loss-making business, they are also looking to monetize that. So these three segments are FY20 outlook for us. And that creates a cash flow generation at a good pace for them. While the crude prices move up, their refinery margins will take a hit. But I believe the gas is the next story for them on the oil and gas side, because gas prices now make it more profitable for even ONGC and for Reliance to start picking it out. And I think in 2020 you'll see a nationwide gas trading exchange as well. So these things trigger out a better valuation in the future. But I think it's better to have a 10-15% kind of a drawdown and then buy rather than buying at a current price.
Okay, that's the view that's coming in on Reliance. I think wait and watch approach is something that the consensus view is on Reliance. But overall, for the long term, yes, there is a bullish call that's coming in on the counter. The next stock we want to talk about is actually a sector. We've seen that the larger private sector banks have run up. We've seen the move that's come in on the counters, like an HDFC Bank or a Yes Bank or an ICICI Bank or an Axis Bank. But of late, we've also seen that the smaller private sector banks, be it a Federal Bank, Karnataka Bank, DCB Bank, they have started to pick up steam. Is there value in some of the smaller banks? That's something that we'll ask. Any of the smaller private sector banks, Lancelot, that are attractive that you've recommended to your clients at this point of time?
See, the smaller banks which follow the traditional model of business, I think are going to face challenges when their size grows and when they are competing with the big banks. So rather than looking at the Federal, Karnataka Bank, etc., I think the opportunity lies in banks which are new age banks, where like IDFC First Bank, Bandhan Bank, which is now merged in with Cunha, because these banks do not have the legacy of building out the huge network, etc. They are using technology to actually reach out to customers. They are generating CASA from people more on online banking, and that's where the new millennial business is. So I think from that perspective, these banks are a better opportunity for longer term growth. However, you will find that most of these banks are very highly priced. Like IDFC First is now trading almost 2.2 times book. Bandhan Bank is almost 5 times book. So one would actually have to wait for some correction in these prices to pick them up. But if you're looking at the longer term, I think these banks have a better growth trajectory as opposed to the traditional but smaller sized banks.
Okay, that's the view. What about you, Samir? Among the smaller banks, are you recommending anything to your clients?
So we are not picking up over there because I believe then if you want to take that kind of a risk, we are preferring a small PSU banks over there, which have come out of PCA as of now. If you see the private banks, what happens when they try to grow out the branches? They face that competition, and now what is happening? Everyone is fighting for the same retail pie, which is getting smaller as the consumer demand also takes a hit. So I think over there the risk will pass on to smaller private banks, and there will be a certain kind of a upcycle in the asset quality deterioration. So over there is that kind of a risk, and because they're concentrated to certain states and limitations, they face a lot of risk involved with that state. So I think it's better to stay away and stick to the larger ones.
Okay. So you will stick to the smaller PSU banks or the larger private sector bank? Okay. What about you, Vinit?
Clearly one of our biggest buys in the private sector banks, small banks, is going to be RBL Bank. So, just to, you have a bank which is a century old, like City Union Bank. So it's about 30,000 crores of AUM. RBL, in a span of 10 years since they came into being, when they were material, they were 1,000 crores lending in 2011. Today they are sitting at 50,000 crores. And over the next 4 to 5 years, they'll be a 2 lakh crore kind of bank. So I think that the growth trajectory is very well in place. Their model of lending is very differentiated. They know exactly what they're doing up, and they're scaling very sharply. Fee income generation is fantastic. And so I believe that this is one stock that I will go with. Okay, it is very reasonably valued for its NPAs. They're slightly on the higher side because they have a very huge portfolio of unsecured debt, likely to remain high. But I think, you'll see the NIMs grow and compensating for that. And the ROE will also keep expanding. So I think over the next 4 to 5 years, ROE could start hitting 18-19% in line with the other private sector banks, which are the larger ones. And I still think that there is strong re-rating chance available out here. So the bank is available at 2.8 times FY21. We could see it grow by 50% over the next 12 months.
You think it makes sense for someone who's investing to bet on some of the smaller private banks over the larger banks, or you believe that the outperformance of the larger ones will continue?
I think the outperformance of the larger ones will continue because in a bad time, these banks have not really done well. They have not shown the DNA to scale up or escape the impact of NPAs, whereas the larger banks have been able to do it. And the banks who have risk aversion in their DNA while still wanting to grow aggressively, I think you should clearly be on the lookout for them. And all these state specific regional banks will very soon lose market share.
Okay, that's the view. And before I move on, Lancelot, is this a similar view that you have? You believe that the larger ones will continue to outperform? If given a choice between larger and smaller, we obviously asked you on the smaller banks, which one would be a better fit at this point of time, given the run-up that we've seen?
I think the larger ones will continue because you see, over a period of time, banking again becomes commoditized, and the larger banks are able to generate higher, returns because they're able to generate lower cost of funds. So obviously then, given the size and the kind of reach that they have, you will find that larger banks continue to grow and survive as compared in a difficult environment as compared to the smaller private banks.
Okay, so that's the view that's coming in on the smaller private sector banks. The other sector which has been buzzing in trade is the multiplex of the cinema stocks. So obviously the two large ones that are listed include an Inox Leisure and PVR. Both of them are doing well, both of them close to record highs. Obviously they had a dip in between in terms of that entire you can take your food inside the theater, that controversy that happened. But post that, both of them have managed to rally very, very smartly. And in the last 12 months, PVR is up 35%, Inox is up 22%. Samir, what's your sense on the multiplex stock? Have you advised any of your clients and you believe this rally can continue?
So we are sticking to Inox over there. What has happened is now it's playing a catch-up rally as well to PVR. And if you see this quarter, Jan to March, around 1150 crores in box office gross collection has come up. That's one of the highest quarters and one highest quarter 4 earnings for cinemas. And I believe even if that translates into a 30 to 35% of YOY growth, that comes very well in Inox higher margin base. So what has happened, Inox has had this kind of a transformation in last 6 to 9 months. It's brought up certain premium cinemas, especially in the tier 1 cities, and that has picked up as well. So over there the margins are at least 1.5 times of the regular cinema. So over there I believe this will start translating into the numbers going on to Q4, Q1 to fully, and Q2 onwards. So I prefer Inox over PVR as of now.
Okay, what about you, Lancelot? Any of the multiplexes stocks that you've recommended to your clients and you believe, what's the outlook on them?
So I think multiplexes as a business, are very much dependent on the content that gets generated during that period of time. So that is the challenge that they have, because in the last quarter, yes, you did have a large amount of hits coming in and you do have a pipeline going forward, but it's very difficult to predict as to which movies will really hit and which will flop. So also given the fact that you are seeing companies like Netflix, Amazon Prime, and you have the domestic companies also coming in similar platforms, it's going to take away some portion of their market share or viewing share from the regular cinema goers. So I think long-term challenges will definitely creep in, and during periods of let's say low movie releases, that could create problems for these companies. So business is going to be a little bit cyclical, and one has to actually buy into these maybe at lower end of the cycle so that you are able to exit at higher end. But it's very difficult to take a long-term call as to what would be the outlook for these businesses maybe 5 years from now or 10 years from now, because technology can change things very, very rapidly.
Is that a valid point, Samir? The Netflix and the Amazon, I think the entire scheme of getting movies at your fingertips, is that a big concern that you would have if you're betting on the multiplex?
So if I see next 10 years, yes, it's a concern, but if I see next couple of years, I don't see that as a big concern. If that was the case, then this kind of a gross box office collections wouldn't have been there. And even if you see this quarter, what has happened, a lot of English movies have come up, where they have superseded the Hindi collections. So that trend of going to cinemas and buying a higher price ticket, see now what is happening, the prices, even after the GST rationalization, everything, the prices have not come down. So I believe over there that kind of a push is still there in the margins.
Okay, what about you, Vinit? What's your sense on the multiplex space?
So I think PVR compared to PVR, Inox offers a lot of value. Differentiation in their product offering in terms of the viewing experience has kind of narrowed down. So they've got a lot of premium properties also, and it's available at very benign valuations. And what is good for PVR is also good for Inox. So there is no differentiation on that. But having said that, I believe that a content will rule the footfalls to the multiplexes. And to that extent, I am not very gung-ho now that the valuations have caught up. So I would prefer a content player who is, feeding to the OTT. And one player out there which I think is outstanding is going to be Saregama. So they have practically with their device, the Kalra is doing very well. They are selling about 11 million pieces as we speak, and they're targeting about 3 crore, So that's a very big traction that they will see there. Additionally to that, they're doing a lot of this small time content, which is just below 1 crore kind of production cost, and they've been doing fairly well there. So I think as a content company, they're emerging very strong out there. And now with the success of Kalra, they have got a lot of money, to build on the business model further. So I think that stock can do really well.
Okay, that's the view that's coming in on the multiplex chain, and I think Inox seems to be the preferred choice. And finally, it's the start of the new year, new fiscal. In fact, which are the top stocks that our experts are telling their clients? So I'll start with you, Vinit. Which is the stock that in the recent times that you've recommended that one should hold for at least a year, that they could get some sizable returns?
So without naming the stock, I think the power generation stocks are one good category to go out with. So there are a lot of factors which are falling into place. One is the fact that electricity demand is going to grow at 6 to 7%. There's a lot of base load capacity which is going to go off grid because it is unviable and it's very old. It's about 25,000 megawatts. So the thermal capacity generators who are there, they're going to see a lot of money being made. And if you see, there is a lot of resolutions happening in the power sector with respect to these generation companies. So I believe that there is a lot of money to be made, and this is the time to get into these stocks, and there could be potential.
No, why not naming? You said without naming them.
So we're doing some work on that, so I cannot name them.
Okay, that's about it. So power generators were basically something that you would bet on this time. Lancelot, which stocks have you told your clients to accumulate for a year basis?
So I am actually bullish on the insurance, life insurance and the general insurance sector. And I think if you look at the rallies, we haven't seen these stocks rally. In fact, they have actually come off their highs. So you see HDFC Standard Life had gone to 550. It's now at about 380, 375 levels. ICICI Pru Life had gone to 470, 480. It's at 350, 360. Recently, there was a very large deal done at, the 322. So I think the good thing about this sector is that the pricing has sort of come off, but the business has continued to grow. And the business is now shifting in favor of protection. And that's where the big money is coming in because of the protection business. And for all the insurance companies, we are seeing them focus on the protection part of the business. The ULIP policies are not really taking off in a big way, but protection is compensating for their and because of the size of the under-penetration and the future growth, all these companies, even though they are all competing in the same space, are growing at 25 to 30% year on year. So I think this is a great space to be in, and at this point in time, HDFC Standard Life Insurance, they are a good opportunity to buy in. ICICI Pru is a good opportunity to look at. And even on the general insurance side, you will see outperformance coming in. So you have ICICI Lombard as well in that space. So these are the three companies one can look at on the life insurance and the general insurance space.
Okay, so power generators, insurance, both on the life side and general side, is something that's been spoken about. And Samir, which stock?
So for me, ONGC is FY20 pick.
Okay.
I believe gas prices already have now become profitable for them for the first half. So that will push the valuations as well. And over there, crude prices we believe will hit back to 80-85 in July or August, given the sanctions and the production cuts which are coming from even Saudi. So that will push the crude prices up. The subsidy issue might reflect the issues as of now in the price. Even a further 10% down, we don't believe it's a bad place to buy in, because after that the run-up will be really smooth enough. And we believe this is a place where exploration is picking up, and for them the difficult fields are coming up in next 6 to 9 months. So that gives you a higher pricing power. So I think this is a place where we've put money out here.
Okay, so that's the view that's coming in on the final stock, that is ONGC. So those are counters that you need to watch out for: the power generation space, ONGC, as well as the insurance space. But with that, it's a wrap on today's edition of Hot Money. Many thanks to all of my guests for joining me. Thank you, Vinit, for coming in. Lancelot, Samir, thank you so much for coming in. Ask BQ comes up next. Stay tuned to Bloomberg Quint.